You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Hey guys, welcome back to another episode of Market Champions. Today we've got Lily Francus, one of the smartest people on the Wall Twit community. And thank you so much for being on the podcast. She's a very big name options trader. You can learn a lot about options and volatility and derivatives. And if you're into the quant world, you should definitely give her a follow at Nope. It's Lily on Twitter. So thank you so much for being on the podcast. It's awesome having you.
Definitely. Thanks for having me. I'm coming live from my parents' house. So decor and background totally picked by my mom.
Awesome. So I first wanted to start off by asking you about your background, how you actually got introduced into the trading world. Remember you said, you pretty recently got into the world of trading. So could you sort of give us a description of, your journey to that?
Definitely. So, I've been in the market for years. My first, foray, my background is computer science and business administration from undergrad. So I had, your basic finance background of, how do you price a bond, or, what is compound interest? The boring stuff that they make beginner finance majors learn, which is okay, maybe more people would do this if you taught them about options first. But I started in the market in about 2016 when I got my first stocks. I had a 401k, I had my employer stocks, I had my own portfolio, I'd tried for years stuff like Wealthfront. So I wasn't, complete novice or completely unknowledgeable. One of my biggest reasons that I went into the market last year in the trading, meaning of the word, was the coronavirus pandemic. So two things happened with me. One is I was a software engineer and I was just I was doing web dev and I was I cannot do this when I'm 30. Some people love web dev. Some people are fantastic full stack engineers. I wanted to go back to school. So I, applied and got accepted for a bioinformatics PhD, which I'm currently a student at UC San Diego. And I realized that would be a lot less money per year when you work as a PhD student versus a software engineer. Right. So I got into trading in April of 2020 as mostly as a way to supplement my income during school.
Mm-hmm. And then it sort of took off from there in a way.
Yeah, it was interesting. The way I describe it is the first month, it was easy money because everybody was in the market and it just crashed. Everything was going up, literally could buy calls. You were a genius. I think I made $20,000 with $6,000 my first month. And it wasn't because I was a genius. It was just because everything went up. So if you bought calls, you made money. Right. I remember one night, I was holding $1,400 worth of Boeing. Mm-hmm. When it rose from $150 to $200 in a week in June. And I woke up and I was I made $4,000. Wow. My first option trade ever was in April of 2020 with Groupon, and I didn't know what an option was. And I bought a call on Groupon on Robinhood and I made 100% because it was just that easy.
And then you sort of got into sort of the smart ways of doing things, building cool indicators like Nope, which we'll get into. And
so this period, the halcyon periods of your youth was May of 2020 when everything went up. So it was right. You couldn't really fuck up because even if you could go to your cat and pick stocks and it was making money. And that changed in June. Right. June 8th, a lot of my friends over the past month got blown out because guess what? The market sometimes goes down. So when that happened, I lost a bit of money. I didn't lose much because I was never over leveraged like some people I knew. But I was like, okay, this is no longer free money. That's cool. So around June and July, I really started investigating. I think the first month I didn't even know what the Greeks were. Like, you didn't have to.
Right.
But then I started investigating, using my quantitative skills as a, software engineer. It's like, this can be solved. So one of the reasons, I got into Nope was I was in these day trading communities online on Discord. My favorite and my first one was Unusual Whales, where he's actually a friend of mine. He makes an option flow tool. And basically, I was inspired to look, could you predict earnings using options? And I mean, historically, of people like Tasty Trade Crew, like Tom and Bat, they're like, nope, option flow do not have any meaning. It's useless. Don't bother. And that was quite a different story from what we observed in Unusual Whales.
Right.
I mean, we saw that some earnings, it was obviously insider trading. You had these severely out of the money call options being bought. And I was like, could you predict earnings? Because there's a lot of money if you guess right. You can turn $1 into 50,000. My favorite was Zoom, where it went from $300 one day to $420 the next day.
Wow.
And it's if you had bought a call, you would have made so much money. So I mean, and then I can go into more about how I created Nope and what brought me on Twitter and what brought me here.
Yeah, so did you actually find a way to predict earnings beforehand? Because you found out that there's a lot of money to be made, and you saw insider trading. And
so we started looking into the earnings prediction using what is now the progenitor of the Nope model in July of 2020. And our initial results seemed good. We actually saw patterns, and we signed up because, remember, we're broke 20 something year olds. We don't have option metric status. We signed up for this service called OmniQ, which was run by some guy who basically abandoned it. And it was $40 a month for historical option data. And when we used it, it was holy shit, with this, it's 70% of the time it predicts earnings. That's amazing, right? And we calculated it was something 1,300% ROI.
what?
And the data was crap. We could not see, there was leakage, but we saw in October that the deltas they were giving us made no sense. And because of that, we could not replicate our results.
That sucks.
So yeah, I mean, that was one of the major reasons why I don't predict earnings anymore.
And I remember, I remember watching your, I guess, interview on reversions and diversions, which is your YouTube channel, which you run with Monica Turi. And I remember you mentioned that you got the idea from Nope, while you were hanging out at an apartment. So could you sort of talk about, number one, how you got the idea for Nope, and how you went about actually finding, testing, and yeah.
Sure. So I mean, it's kind of complicated how I had the idea for Nope. The answer is I don't even remember exactly how I invented the formula. I mean, now if you read Option Degenerate Marketplace, of course it makes sense that it's related to liquidity, duh. But remember, I mean, at the time when I invented it, I didn't know the difference between I didn't know open interest versus volume because I was still very new to the markets. And I just observed this ratio. It made sense to me logically that, oh, this is a comparison of options, price impact versus, shares, because that's what the formula is effectively saying. But it didn't make there was no deeper meaning at the time when I invented it. I actually hunted for meaning once I started observing it, because I saw these weird phenomena, and I saw how it was predicting the market crashing. The seminal moment for Nope on SPY was we had started, so I'd started using it for earnings in August, and I was like very, very, very sure that it could only be used for like binary catalyst events. I was like, this only makes sense in the context of like a binary catalyst like earnings. And someone was just like, could we see it on SPY? And I'm like, no. I'm like, no, this doesn't make any sense. Like, don't. And I was like very vehemently opposed throughout August of using it outside of earnings. And I think finally I relented around like end of August, and we turned it on and we saw these crazy readings. We saw end of day was over 100, like multiple days in a row. And I remember like looking at this, and I had seen the same thing happen on Apple before it tanked. And I was like, wait, this is a bad sign. Like, this is something that is wrong with the market.
Mm-hmm.
And the day that I saw it last was September 2nd. And I spent September 2nd warning people to get out of the market. And then September 3rd happened.
Got it. And so could you talk a little bit about how Nope works, and how someone can actually go on to nopechart.com and use Nope to identify, number one, exploitable trading opportunities, and second, could you talk about, what did you see using the indicator that told you that we were going to see a correction in September?
So I'll talk about the last one first. I mean, I had just seen this happen on Apple, I think right before. So Apple in August, if you remember, went on a massive bull run.
Right.
And this was sparked by supposedly the share split, which of course matters in 2020. And I just remember seeing these high ratings on Apple, and the next day Apple was down like 3%. And I was like, okay, that might be related. And I saw these high ratings and I saw the like raw values, and I'm like, this is not even a retail game. You saw like 2 million coal contracts traded on Apple in one day. And I was like, there is no way this is Robinhood. Like, you don't have the scale as retail investors to trade 2 million coal contracts on Apple. And I saw it next day. So my monkey brain was like, wait, maybe there's a relationship between these extreme values and red next day, or like it going down next day.
Right.
So when I saw this on SPY, I was like, hold up. I was like, okay, this looks bad. VIX is going up. Nope is, going haywire. The market is like mega rallying. Like, I don't think this ends well. So that was like kind of my first hypothesis. And then the market crashed, or correction, if you want to call it. And I'm like, wait, hold up. And we saw the same thing happen on October. We saw the same thing happen in late November. We didn't have a correction, but we had like a week where it went down 2% right after. We saw the same thing in January, and we saw it happen then, and we saw the same thing mid-February, and now we see what's happening now. So I mean, I've looked in historical data. I actually wrote a paper on, this end of day effect, where I could see it happening since 2007. So I was like, whoa, this is not just some random fluke. This is like related to the market going down.
Right. And so could you also talk about how, people can actually, what exactly, what's the idea behind Nope? What it's trying to track? And, could you talk about how people can identify exploitable opportunities using Nope?
Sure. So, I mean, the only ticker that I have like full confidence in using it so far is, the S&P or SPY. Not because I don't believe it exists on other tickers, but more just because all my research has been on that, since it's effectively the market. So, when you predict the direction of SPY, you're effectively predicting the direction next day of Facebook or Microsoft or any of these. And what you can do with it, so we found two use cases for it. The first one, of course, is this crash prediction. And, I mean, I publish it on Twitter. When you see these extreme positive values, it's usually considered a bad sign. And, you could pull the data yourself from ORATs or SIBO directly or other end of day providers, or you can message me and I'll give you it. And basically, you can use this kind of as like a hedging technique. Like once I saw it in mid-February, what I did was buy puts on my longs, like to cover them. And they're already up like 200%. So the other use case, other than speculation for like the market going down, is like intraday usage. And that's probably the most popular use case for it, where we see these things called reversions, where, SPY itself normally goes up and down per day. It's, kind of like a sinusoidal wave of sorts almost. And what we notice is that at these high values, so high negative, high positive, SPY seems to revert. So the price changes direction. And I was very confused why I did that for months, because I was like, well, why is this weird indicator doing, like, why does it seem to predict the motion of the S&P?
Right.
And what happens is it's effectively a measure of liquidity exhaustion. So, when the options market is heavily dominant on SPY, so if there's a lot of calls or puts traded, what that just means is that the market has a tendency to reverse direction because, and I describe this more in detail in my posts on option degenerate marketplaces, but what it means effectively is that hedging requirements are exhausting the market and causing direction to change.
And so, you describe it as sort of a structural inefficiency. So I remember when you were talking to Jim O'Shaughnessy, I believe he said that this cannot be arbed away because it's a structural inefficiency as opposed to something else. So I wanted to ask you, firstly, you talked about liquidity, and you said that it's liquidity that's actually driving all this, and it's liquidity exhaustion that's producing these signals. So how do you define and track liquidity? That's the first part of the question, and the second part of the question is, I was just curious, how long has this structural inefficiency existed? So in a sense, how long has sort of market maker delta hedging actually driven the market for?
I mean, if you're familiar with options, I mean, it's something that's been known by traders since time immemorable. I mean, I think
Right.
Hull and like his book in the early 2000s notes it, and I think dynamic hedging does too. I mean, it's basic mathematics. So from my data sets, it looks like it became a dominant force around 2017.
Mm-hmm.
It got worse in 2018, especially with Volmageddon, where a lot of this short Vega trading, once XIV blew up, moved over to, the SPX complex. But yeah, I mean, it's become a more and more dominant force. I think pretty much it's indisputable at this point that options drive the market.
Got it. And could you also talk about how you define and track liquidity?
So liquidity is this nebulous concept that everybody uses the word liquidity, and it doesn't actually mean anything. I mean, my effective measure of liquidity, there's two ones that I look at three ones I look at. So on SPX, the major ones are VIX and ICJ, so the implied correlation of the SPX basket. Why that is useful is theoretically there's dispersion traders who, what they do is when the implied correlation of SPX increases, they do correlation trading effectively to bring it back into line because there's an arbitrage opportunity there. And what happens is when ICJ spikes, for instance, that implies that they're not trading because they're afraid. And when they're afraid, and also there's also co-movement when stocks are going down, they tend to basically correlate with one another rather than going up where they don't. So ICJ spiking is one of my number one like fear signs, and I saw this happen exactly on January 27th. VIX is a good measure of illiquidity when we're looking at market depth, because as VIX, increases, market makers and other high frequency traders stop trading effectively, since it becomes too volatile to, predictably make a profit, as well as when VIX is extremely elevated, so effectively, because market makers and HFTs are not operating on the SPX complex, then the bid-ask spread widens and the market depth at any given price point decreases. So those are two measures. I mean, market depth in this case really is, given SPX or some ticker is, let's say, $5, how many shares in one direction would it take to move it $1? So that's a good measure of liquidity. I think the most popular one that I know of is just the bid-ask spread. So as the bid-ask spread widens, it becomes harder and harder to transact without moving the price. So it really, I guess, depends what you ask, but most of the time they tell you the same thing.
I also wanted to ask you, this is sort of, I'm not sure if you've actually looked into this, but I'm just curious. So, a lot of people, especially on the value investing side, they tend to look at micro caps and small caps. So, I was just curious, in these places, the option markets tend to be more significant. So, how would NOPE be used in micro caps, where sometimes the options market in the stock is very significant?
Yeah, that's a good question. I haven't investigated it yet exactly, and I don't want to give away all my secrets. So I'll leave that as an exercise for reader.
Got it. So you sort of don't have sort of the traditional finance background in a sense. You found it on your own. So how do you approach learning so deeply about options coming from a non-finance background? And what are sort of the key takeaways in your in how you actually got into the field? And if you had to unlearn and relearn trading again, how would you do it differently?
So yeah, I mean, I get asked this question a lot from people, and I mean, my good answer is I didn't read any books. I mean, when I'm interested in a topic, I effectively fixated on a pretty small niche, which was, let's say, dynamic hedging. And you just read papers. You just keep asking questions. You find one really big, stupidly complicated question. Like, for example, nope, the prediction was, could I predict corrections? Like, that's stupid. And like, everybody would want to predict corrections. And chances are you will not get a good answer. But the more you work at it, the more you understand your question, the more interesting stuff will fall out of it.
And if you had to sort of unlearn and relearn it, would there be anything different that you did, or would you just sit down, read papers?
I mean, I think it would have been nicer to realize earlier what I was looking at, because I was very much in the beginning on my own when understanding this stuff. It really accelerated once I got on Twitter in October of 2020, because I was in day trading communities, and like, of course, there's a couple very knowledgeable people there, but most of them are there to YOLO and barely understand maybe the Greeks, maybe. And you're not gonna, like, good mentorship and a good person to like bounce ideas off of is like super invaluable.
If I believe you're starting Salience Capital, so I'm just curious, what is the hardest part about raising money to start a quant firm now?
That is a great question. I mean, we haven't raised yet effectively. I would say what the most difficult part would be, from what I can see, and this will go back to my background, because I've actually done startups before. I mean, I founded a startup a couple of years ago in the autism health space, and money is easier to get nowadays than it used to be, for instance. that it's more difficult when you're an outsider. It's more difficult without a track record. And it's definitely more difficult, I'd say, when you have this, let's say, novel philosophy, when you're just like, this is completely different than, what other people are doing, or if you're focused on, let's say, this completely blue sky question, that may not be amenable to a lot of investors, especially if it ends up, being useful on very short timeframes or in very like risk-loving strategies. So ask me in a couple of weeks, maybe I'll have a different answer.
So one of the stocks that I believe you've been talking about was RKT. So out of curiosity, what is the ideal stock in terms of, say, market cap, options liquidity, and so on, if you wanted to pull another GameStop or pull another AMC? How do you identify a meme stock before it becomes a meme stock?
See, that's another one where I'm probably, I have some proprietary methods, which, I'm working on. I'm not, as I keep telling people, I probably gave away too much of what I do, mostly out of inexperience. So I'm trying to leave people wanting to know more. But stuff that I've written about before, with these meme stocks, they tend to be low cap. They tend to be salient in the sense that, they have some kind of memorable aspect to people's, livelihoods. So stuff like AMC, that's a theater that people went to when they were children or still go to. GameStop, we all know what GameStop is. Quicken Loans, a lot of people have done Quicken Loans, and also its name is literally Rocket. So there's a lot of like thematic reasons. Another one is like in the short interest trade now of Tootsie Roll. Tootsie Roll is just like, who is bullish on Tootsie Roll as a company? It's kind of funny and also kind of ironic. And those together tend to make meme stocks, as to like why they've happened, let's say right now, and why Rocket versus, I don't know, Nokia or BlackBerry or something. That's more proprietary and something I'm currently refining. But there's a lot of, pretty obvious commonalities between all of these like meme stocks.
Got it. And you can't forget the fact that it has to be bankrupt and it has to not have any cash flow.
Basically, yeah. It's like it's completely divorced from this idea of this is a good investment. Like
Right.
Most of these meme stocks, if not all of them, may have some minor kernel of like, yeah, there's like a actual value in here. But a lot of them, everybody knows is like a gigantic game of greater fool. So it's just like, make sure you sell it on time, I guess.
Do you think it's sort of gone too far? Because I believe last month or the month before that, we had these Wall Street bet guys trying to actually squeeze JP Morgan out of their silver position. And so, yeah, do you think it's going too far, or are you happy with where it is because, you're making a lot of money?
Honestly, what I was going to say is it's definitely gone too far. It's not a new thing. You saw this in 2018 with the crypto run, with the weed run, with the tech mania in the 2000s. Like, it's just mania in itself. In a lot of cases, this will end with retail holding bags. That's what we saw with GameStop. But, eventually it'll probably stop. Enjoy it while it lasts.
Right. And, I wanted to go into sort of a bit of your trading. So, how exactly, or, what factors influence how you structure an options position or how you express a view?
In general, lately I prefer to be long versus short. So I tend to buy options more than I sell options. That said, I also do a lot of spreads because, I try to design a position based on maximizing my perceived risk versus reward. So lots of spreads, spreads tend to be better because, the risk versus the reward on the position is greatly diminished.
Mhm.
I do a lot of reversion trading with Nope. So in those cases, I effectively just use like one wide SPY spreads.
Right.
So when I do meme stocks, sometimes I hold overnight with just shares. But with options, I'd say mostly debit spreads, sometimes calendars if I want to express, let's say, a Vega position.
Got it. And I also wanted to ask you, you've got sort of this skepticism for conventional wisdom, and one of the key takeaways from your interview with Jim O'Shaughnessy was that you said that people who use technical analysis, they tend to base their trades on belief, while you base it on models, especially those that are quantitatively tested. So how did you develop this apparent skepticism for conventional wisdom, and how did you decide that you were going to figure everything out independently?
I mean, I'm a very impatient person, as well as someone who does not effectively work under like authority. So I always question things. Um, I'm also an empiricist. I mean, I'm a PhD researcher, so I kind of apply the same understanding of science to trading versus, let's say normal people who might be more rules based or might be more greed based or something more emotional and, dare I say, irrational. And at the end of the day, it's like if you have a model and it doesn't work, then you throw it out. You're not emotionally attached to a system. And I've seen with technical
Right.
analysis, especially, that people get very defensive because not only is it not falsifiable usually, like it's very difficult to find a set of rules with technical analysis where you could say, based on, let's say, Karl Popper's theory of falsifiability, it's like you cannot prove this works or doesn't work.
Yeah, you
Like you
can't
can
do either.
always post facto interpret it. And an indicator that you prove can predict only in the past is not very useful. So I'll give you a good example. There's a really common indicator called RSI, the relative strength
Yeah.
indicator, which, if you look at it in the past, it will usually spike before most major corrections. And with that, it's like, okay, maybe it's predicting, disaster, right?
Mm-hmm.
But the issue is it does spike before corrections, but also spikes literally like all the time. So you have this issue of like there's no sensitivity with it because if you look in the past, yes, RSI will spike before, let's say, a bull induced mania correction, but you cannot going forward know that you're about to correct.
But can you not use that?
So,
Can you sort of not backtest that and figure out whether it actually works or not? So you could just, because it's RSI compared to say head and shoulder spread, it's significantly more quantifiable. So you could say that every time it goes above the 70 level, or every time it goes above the 80 level, and I'm going to go short.
so yeah, I mean, I mean, at least it's quantifiable, like you said, versus, let's say, visual. But from what I've seen, first of all, RSI has different patterns and parameters you can use, and you can, of
Mm-hmm.
course, fit your model according to whatever parameters look better on your back test. But it's also, like I said, it's just not specific enough. You know, you will see, and I mean, I've looked at RSI in particular because oftentimes it does give similar ratings to Nope. And it's like maybe these are identical. Maybe you don't have to do all that option, mumbo jumbo we do. But at the end of the day, Nope tends to be specific. So I know if Nope is really elevated end of day, I know that's a warning. I don't know the same thing with RSI.
Got it. I also wanted to ask you, one of the things that you mentioned were models, and I wanted to talk about a different kind of model. So do you sort of have any of your own option pricing models? And if so, what kind of additional information or parameters do you account for that's not already accounted for in the Black-Scholes model? Or are we
I no, I don't. I mean, I've thought of option pricing models. I mean, Nope effectively, and this I'll give another exercise to your viewers. It is an option pricing model in itself. Effectively, it effectively will tell you when options are mispriced, by nature of what it is, but I feel in most cases, especially for retail traders, you're not going to find a significant edge by making a new vol surface or a new pricing model.
Are you on, this is something, I got quite frequently on Twitter. So are you on Team Python or Team R, and why?
Python, for sure.
Why?
R, I hate the syntax so much. I mean, Python is probably slightly slower, although you can compile it, so should be as quick as C theoretically. But R, I don't even know very well. I mean, Python is so intuitive versus R.
Mm-hmm.
I used to, way back when, be mostly in Java. I've gone through a JavaScript phase, but now pretty much all my data processing is in Python.
Got it. And, one more question that I wanted to ask you about options is, options are by definition basically the expectation value of, the spread above versus below the strike. So, in the long term, fundamentals overall tend to reign, supreme, and overall stocks tend to usually be concentrated in one order of magnitude. If you take, for example, the price to earnings ratio, most of them tend to be between a ratio of 3 and 30. Despite the distribution of, say, the daily log returns being consistent, with the underlying being part of some complex stochastic process, for example. Do you think quants are adequately incorporating this information into their option pricing models when they're taking longer term trades?
Sorry, can you repeat that? Feels like an interview question.
So I was basically saying that in the long term, fundamentals tend to reign supreme, but then you can see that most stocks tend to usually be within one order of magnitude, right about 3 to 30, for example, if you take the PE ratio. So I wanted to ask, the distribution of the daily log returns being consistent with the underlying is part of some complex stochastic process. So do you think, quants are adequately incorporating this information, the fact that, fundamentals over the long term tend to reign supreme? Do you think, quants adequately incorporate that information into their option pricing models when they take longer term trades?
I would assume macro quants, and it really depends on your time horizon. I mean, effectively, if you're looking at, let's say, a couple days, a couple weeks, fundamentals are not a significant driver of the stock price, effectively, especially not right now. When you're looking long term, of course, you have models like CAPM or like classic fundamental valuation models, which of course may reign supreme, although debatable if it still will going forward, especially after the Federal Reserve's actions over the last 10 years. So effectively, I would say yes. I mean, fundamentals are just one method of valuing the stock, which theoretically represents some portion of a company. In actuality, it's almost like you said, the stochastic process, which you attach some narrative to value it. I mean, the theoretical model of stocks was, okay, we're going to give you some cash flow in exchange for buying a part of the company. And that works, of course, with dividend stocks. It's very obvious how those generate money. So, of course, given that they create a cash flow, they have a net present value. But there's a lot of stocks, especially tech stocks, which have no dividend. And effectively, in those cases, what you're buying is this idea that the company will be worth more in the future.
Mm-hmm.
So that's where fundamental analysis, of course, comes from. But now you have this third level of, not only are you valuing companies according to what it should be worth in the future, according to, let's say, some fundamental metrics, which of course are just some story you're telling about the company in the first place. Because at the end of the day, those fundamental metrics, to have any logical value, they need to create some cash flow eventually. Mm-hmm. Like Amazon can get away with not paying a dividend, but theoretically, you are valuing Amazon now according to the understanding that in the future you will generate money through the stock. But now you have a third layer of valuation where, and this is kind of on the salient side, where not only are you valuing according to fundamentals, but you're also valuing according to what you think other people will want to pay for in the future. And that's something that's not even a new concept. This is Keynesian
beauty contest. Yeah.
Exactly. So in those cases, I have not worked in industry. I couldn't tell you what macro quants, are doing, especially with longer term time horizons. I know, Jim O'Shaughnessy at OSAM, they're a longer term holding company. They look at social data. They understand this process, the third layer that I just described.
Right.
Could I say this about the whole industry? Maybe not. Would I say that fundamentals on the short term play a significant role? Probably not as well.
Yeah.
But I mean, Graham was correct when he said a long term the market is a weighing machine. So eventually there will be reckoning.
Right. And I believe Aaron Brown, if I've gotten his name right, he's a quant trader, and he's also talked about, for example, in a poker game, level 1 thinking is sort of caring about what your cards are. Level 2 thinking is caring about what your opponent's cards are, and level 3, as you mentioned, is caring about what your opponent thinks your cards are.
Exactly.
And,
I mean, that's effectively the salience aspect of it. Like when you're doing a salience, when you're trading in the salience, or trading in salience in a hyper-connected marketplace, as my blog post is called, what effectively you're doing is you are betting on what you think other people think will be worth more in the future. That's effectively what salience is.
Right. So what do you mean by, it's a stupid question, but what do you mean by trading salience? Because I thought salience means like important or noticeable or something like that.
It does. I mean, it's basically, it's the same as like when you say you're trading gamma or trading vega. Like what you're saying when you're trading salience is you are predicting what other people will think is memorable or important, and those stocks in the future will be worth more money. So that's why you have these. This is why salience plays, they call them, are high momentum plays, because usually when you're betting on this, you're betting on it making a lot of money really quickly, because once you predict this trend, let's say through a gamma squeeze or through, let's say, a news item, the market will shift immediately and you'll see stuff like rocket going up 70%.
Right, got it. And I'm curious, one of the things that most options traders tend to try and exploit is this idea of a variance risk premium. So, if for listeners, variance risk premium is basically the tendency of this implied volatility to be greater than realized volatility. So I was just curious, apart from trading NOPE, do you have what are the different strategies that you use to identify these overpriced variance risk premiums?
I would say lately it's mostly the opposite. I would say, you want to be long gamma.
Got it.
I mean, looking at the market, I have not been comfortable selling options in a couple of months.
Got it. And could you talk about why?
I mean, it's due to a couple of factors. I mean, once you are in this options liquid marketplace, you have magnification of volatility. And when I say volatility, I mean like actual volatility, not implied volatility.
Mm-hmm.
So you see these massive moves, where VIX, for instance, may spike pretty rapidly because everybody's afraid, even for a pretty small move in SPX. Or you see that, we go from 380 to 392 to 380 again, as we did last week.
Right.
So in those cases, you usually see that the realized volatility is actually greater than the implied volatility. And additionally, what happened with, let's say, the variant risk premium is historically it was a good trade. But if you look at, let's say, put rate strategies or buy rate strategies, where let's say you write a call option against SPX and you create an ETF on it, those have been underperforming SPX for a while.
Right.
And largely because last year the variance risk premium effectively disappeared. The market actually moved more on the indices than you would have got selling options on it.
Mm-hmm.
So I mostly learned this the hard way when I was selling covered calls against my Microsoft shares. And I kept being blown away. So there are safe ways to sell it, but I think in general, these variance risk premium strategies, not only are we in a new market dimension where a lot of participants are not effectively calculating volatility
Right.
and predicting implied volatility, but also it's a crowded trade. Everybody knows how to sell options now. All the pensions, all of these large funds did it for years to juice returns. So you've got it down to the point where effectively you're going to break even probabilistically on selling options. It's not to say that there aren't some single names that still have, a VRP, but I would be careful.
Right. Got it. So I've got 2 more questions for you, and they're not entirely related to trading, but I'm curious. So could you talk a little bit about the cafe that you said you're going to open one day?
I mean, so for that, I've always had this, like, I like to bake. I like coffee a lot. Like, I really love coffee. And way back when I bought like this espresso maker, and I just like have not used it for years because it just takes so much time and I have like other things to do. Same with baking. Like I got from a friend a couple of years ago, like the Tartine bakery book, and I made everything from like eclairs to like gruyères to like brownies, truffles, all that fun stuff. So once, I make a lot of money, hopefully, or something, I would love to like retire and like open a nice cafe where I could just like I could bake things and make coffee, and I wouldn't have to worry about money because of course I'd be like filthy rich. And maybe then I would also have like a stand-up comedy night or something.
That would be fun. That would definitely be fun. I would definitely show up at one of those comedy shows. And my final question is, and this was very popular by a lot of the Twitter community. How does it feel knowing all of your wildest dreams are about to come true?
I mean, this last month and a half has just been really surreal because my parents, when I started trading, like they heard about my model. Everybody knew about my model around me, and like, okay, nobody really gave a shit for like months. I then just started calling out reversions on, Twitter, and everybody at once was like, holy fuck, what? Like, it keeps working. Like, even today, it just keeps working, and nobody understands, like, how the hell it keeps working. So it's been really fun to talk on Bloomberg to people like Jim O'Shaughnessy, who, by the way, is an awesome guy. It's been awesome to learn. I wouldn't, go as far to say as all my wildest dreams will come true yet, because I'm a very pessimistic person by background, which is hilarious because I'm an option trader. So I don't believe it till I see it. And, I'm currently trying to build a business with this. I'm trying to get into the field and, do this cool research and hopefully make money off of it. But right now I'm still a PhD student. So hopefully in a month I'll have something different to tell you. But
Right. Got it. Thank you so much for being on the podcast. And, if anyone hasn't, followed Lily on Twitter at Nopatuli, make sure to check it out. Make sure to check out her YouTube channel, Reversions and Diversions. And make sure to check out her Medium as well, which I think is Mimetics in the Marketplace.
Oh, that's my Substack, but my Medium and my Twitter, so don't worry about it.
Thank you. Thank you so much for being on the show. It's awesome having you.
Thank you.